Hi, this is Adam Stern. Today we're going to review two Orlando portfolios from two different owners. Portfolios are a little bit different. Orlando's been a tough market as of late since prices have gone up and rental rates haven't kept pace. But in a market like Orlando, inventory is always great to get. You'll see the yields, you'll see the kind of properties we have. Should be a good time. All right, so the first thing we're going to do is go to ownamerica.com and click on Orlando, Florida. And that'll pull up all the portfolios we have in Florida at this current time. Currently, we have four portfolios, two of the Orlando portfolios that we're going to be reviewing today. We have another two portfolios. One's a multi-market and one's in Ocala, which is a bit outside of Orlando. So let's review this first portfolio, 10 properties owned by an individual owner. All these properties, first thing I look at is the grouping, really tightly grouped in the northwest quadrant of Orlando, about an hour outside of Orlando actually. Properties are currently managed by one property manager. I consider all of these B properties, properties that are ranging anywhere between $1,000 and $1,300 a month in rents. Properties are a bit older, so looking at these properties, we know that the management and maintenance of these properties over the last several years are going to be important. The seller says that he's maintained these well, and some of these are recently renovated and are not tenanted yet. Some of these are recently renovated and tenanted. You'll see that denoted by the C3 and C2 condition scores. A couple of these properties are actually C4s, which means it's been a little while since they got rehabbed and might have a little more deferred maintenance. But all look like they're about the same quality property. Most of them 3-bedroom, 2 bathrooms. A couple of them a little bit below at 3-1s. And you got a couple that are actually 4 bedrooms plus. So those are the properties. There's the grouping. You look at the financials. Now in Orlando, we've been seeing yields compress steadily over the last several years. Believe it or not, some institutions and some local buyers buy these things at anywhere between an 8 and a 9% gross yield, depending on how nice the properties are. This portfolio is being listed at a 10.09% gross yield and a very believable 5.8% net yield. I believe that number because I see a 42% expense load, which means the property taxes, management costs, maintenance costs, insurance costs are probably pretty much in line with what you'd expect to pay on this portfolio. You can see that the yields on these properties range from the 13 to 14% range, the 10 to 11% range. I'm looking at these properties and I see right off the bat one of these properties is dragging down the yields by a pretty wide margin. So one of the things I like to do is take out that property, assuming the seller will sell you the portfolio without that property being part of it. There's also another gross yield here that's dragging down the average. So let's just see if we took out these two properties, if we'll get an overall better gross and net yield. And taking out those two properties bumps your gross yield from a 10 to just above an 11, and from a mid-5 net yield to almost a 6.5% net yield. I always like to look at home price performance in the market. You can see that Orlando is one of these markets that partied pretty hard during the upswing in the mid-2000s. But when the downturn hit, it essentially fell off a cliff. It got hammered, and prices dropped pretty dramatically. And you can see here over the last several years, from 2012 to just recently, prices have recovered, but they haven't recovered yet to pre-crisis, pre-recession levels. Right now, they're still trading. The average home price in the market is still well below where they were back in 2006, 2005. So you can reason to believe that we still got a fair amount more runway in Orlando. County of Orange, the appreciation rate over the last 20 years has been 5.44%, a little bit lower than the state average of 5.61, but way above the national average of 3.44%. So home price performance has been not steady, but solid over the last number of years. You see that no matter how hard it got hit, the prices came back, and they came back at a pretty steady clip. Part of what's driving home price is population and jobs. So you can see that the County of Orange has gained population every single year that we've tracked since 1996. Inbound migration has tracked inward, so inbound migration has tracked more people moving in than moving out of the county. Unemployment rate in Orange is below the state average. So unemployment is 4.4% in Orange County as opposed to the state of Florida. which is about 5%. And what's driving most of the people is jobs. And you can see that the industries that make up the major employment sectors, obviously leisure and hospitality, Universal Studios, Disney World, all major employers in Orlando, trade, transportation, utilities, professional business services, education and health services, and government round out the top 75% of employers. I always like to look at population in the market. And you can see that Orlando has about 280,000 people as of the 2017 census. And the top employers in the market, probably won't be any surprise, Disney World is one of the top employers. Orange County Public Schools actually employs almost the same amount of people, or the same amount of people as Disney World. The state of Florida, Adventist Health System, Florida Hospitals, Walmart, and Orlando Regional Healthcare System. So what you have as employers in the state or in the county, you have Disney World and all the theme parks, you have public schools, government, and healthcare. You think about the idea that all these sectors might take a dip at the same time. That's unlikely. Even if we hit a recession, if Disney World and the Universal Studios and all of the theme parks take a hit, certainly the schools aren't going anywhere, the state government's not going anywhere, healthcare system's not going anywhere. So a pretty diverse job base in Orlando. And you can see this portfolio, all things being equal. You have a tightly concentrated portfolio of B- B properties. You have financials that if you bought the whole portfolio, you could achieve a 10 gross yield, 5.5% net yield. If you take out a couple of properties, you're well above 11 gross yield and a 6.5% just about net yield. So this portfolio is ready to go out. We'll be posting this on ownamerica.com. Second portfolio right now is 9 properties. Gross yield is lower, a lot lower in this one, starting out at 8.5%, net yield of just above a 5. Very believable net yield since the expense load is about 40%, a little above 40%. So you can believe all of these numbers right here. Taxes are correct, management costs are in line with what you'll probably expect to pay, maintenance reserve, and insurance cost. All segments of that expense roster you can probably confirm as what you'll be paying over the long-term operation of these properties. Properties are, I consider these B plus properties. Properties range anywhere between $1,000 and $1,250 a month in rent. So part of the reason why the yields in this portfolio are lower, the rents are about the same, but the owner is pricing each property a fair bit above the previous portfolio. Some sellers just go in with a higher asking price than others, and the yields look better. Some portfolios move faster than others due to the fact they have owners that are more aggressive or more reasonable with their pricing. This seller seems to be priced a little bit higher than the other seller. So if you look at the yields, not as attractive as the other portfolio, but all it takes is an offer, and you can see whether or not you can land at a yield and at a price point that makes sense for you. 2 portfolios in Florida, a total of 19 properties altogether. One 10 property, one 9 property on ownamerica.com right now. Thanks for watching.